Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to the show. Pleasure for you to come along as we go down this journey of creating wealth through property, our regular monthly instalment of Portfolio Update. And for those of you who are familiar with the Smart Property Investment Show and smartpropertyinvestment.com.au, you'll know that over the last 4, 5, 6 years, we've been following our portfolio as we've gone about a strategy in creating a portfolio, hopefully with plenty of equity in it. It doesn't cost us too much to hold all the trials and tribulations of it. And every month we sort of check in and share where we are and what we're doing. And we've had some fun of this over the last couple of years. We've done some really good renos and we've done videos around it and plenty of stories. Great fun. We haven't really done any renos recently. Well, that said, we did a small one up in Queensland last month, but no major significant renos that I get my hands dirty, and I feel a bit, I haven't really done any renos myself for a while. I always like picking up the tools, but anyway, I'm not going to get into that today. What we're going to go into is some numbers around the portfolio. So the last time we purchased a property in this particular portfolio, it was a set of apartments, a block of apartments up in Petrie. In Queensland, which is right near the site of the new Sunshine Coast University, I think it's called. Huge site, 300 plus acres, and they're building a big university campus in there. So there's going to be a lot of ancillary and sort of subsequent jobs coming out of that, a lot of students. So I think it's going to be a good performer moving forward. Go back and you can listen to that. Last time we did a portfolio update was the 2nd of July. We had our mortgage broker in the studio, Ross Kane from Aussie Parramatta, and we went through a bit of work that we're doing to try and cut some of the costs of holding our portfolio. In particular, one of the biggest levers you can pull is the interest rates and what your repayments are on your mortgages. So we've worked out we can save ourselves about 25 grand just by fixing some stuff, and that's a process that's underway right now and pretty much done. But today we're just going to do a general update on the portfolio and how we're tracking, and to help me out with that, I have my buyer's agent, Steve Waters from the Right Property Group in the studio, and also Michael Johnson, who works with me here in managing the Smart Property Investment Portfolio. He does most of the admin work on it and all the other stuff. Guys, how you going?
Morning, well.
Morning.
Talk me through, Michael, last week, what dominated our mental headspace was messing around with a fee, a $300 fee, that we have to pay in order to receive a professional discount on our interest rates with a particular lender, and the lender is the Commonwealth Bank. Talk me through this, because this is a headache, but I just want this to be a lesson for our listeners around getting your admin right, because I don't think we got it right. I'm not blaming you for that. I'm blaming me for that, because I didn't have enough money in my account for
Under the
fee to
bus.
get taken out. But what happened?
Yeah, well, thanks. So essentially every year we have to pay a subscription fee to a package. It's a professional discount package that our mortgage broker set up for us originally. Essentially what happened was the fee was meant to come out of a certain account, and we don't typically bank with this particular bank.
Commonwealth Bank.
Yeah, Commonwealth Bank. And so we didn't happen to have the funds in that correct particular account. But we actually have, 5 or 6 different loans with them and all that sort of thing. So what happened was the interest rates actually got pumped up to a percentage point higher. I think it was a little bit more.
1.5%. Well, 1.4%. Yeah.
Yeah, exactly. And so that meant that we freaked out and said, wait, hold on, what's going on here? Then we had to do some diagnostics and some troubleshooting with our mortgage broker, Ross, and say, okay, what's going on? How do we fix it? Turned out we hadn't paid our $300 fee. And that resulted in our percentage points going up for 1.5 for all of our 6 loans, which is a significant amount of money.
And I'm not going to say it's the funny thing about this, but the irony of it all is that I think the account where this fee comes out of is a bank account that I set up purely for the purpose of this $300 fee coming out of this account every single year. So I pay the privilege of holding that account for $5 a month. And as you can hear, I'm probably a bit annoyed about all this because it's an absolute joke. So I have to keep this account open so they can take a $300 fee out of it every single year. And at the point in time when they tried to take that fee out, there was only $250 in the account. So they said, you didn't pay the fee, we're jacking up your rates by 1.4%. So we had to go through all the crap to try and get it reset and waste the time of our mortgage broker and the bank to get this reset. So the irony of it is it happens every bloody year. And in the past when it's happened and we haven't understood it, it's cost us on one particular property about $7,000 or $10,000 more in interest by the time we got it reset. That's an absolute joke.
Yeah, it is. This just highlights the importance of getting the small things right.
Yeah.
And this is something, for us, it seems a little bit silly, and that's what we're sort of highlighting here. But on the overall sense, at a principal space, if you look at it, these small things all add up. And if you're not paying attention to the small things, like making sure particular payments aren't paid on time, or if you're not making your council rates on time and maybe not getting access to those discounts, there's all little things that add up that can make your portfolio cost a lot more than it needs to.
And this is a hassle having a larger portfolio. It's not a small portfolio we have, it's a massive portfolio, but it's a considerable portfolio. There are so many different little moving parts of it. And when you think about a $300 fee potentially costing us, it has done in the past, $10,000 in interest payments because of, I'm going to call it poor mismanagement on our behalf. I'm going to say it's idiocy on behalf of the Commonwealth Bank to charge this rather than just letting me walk into a bank branch and pay cash or give them another account that they can take the money from. No, they demanded that I had to have a Commonwealth Bank account to do that. So I think that's an absolute joke. But, they make the rules and I'm the person that takes on the debt. So, yeah, it pissed me off again. Anyway, Steve, what do you reckon? I'm just an angry property investor.
It would be awesome if there were cameras in here to see your face at the moment.
It's poor admitted. Like it's easily like, I don't want to beat the Commonwealth Bank up because these are the rules, right? It's our slip up. We didn't have enough money in a bank account for them to take $300 out.
You need to play by the rules at the end of the day. And unfortunately, and as we always talk about, you need to invest the time. Now, you guys have got a big business to run here. There's a lot more than a property portfolio to look after. So it's pretty easy to be forgotten about or overlooked. But I would guarantee that there are hundreds, if not thousands, of investors that have fallen into the same trap or trick, whatever you want to call it, and cost themselves a lot of money. You mentioned, what was it, $10,000?
Yeah, it was a property. It's probably a property which is valued about $1.1 million up in Mount Ku-ring-gai, which is the upper northern suburbs of Sydney. I think it was a year or two ago. We didn't pick it up for like 5 or 6 months that we're paying this increased interest rate. Yeah, it costs us nearly 10 grand just on one property in extra interest repayments.
So that's like nearly $200 a week or $190 odd a week, equivalent in rent, whichever way you look at it.
Yeah, and it's as simple as it's poor mismanagement of our portfolio.
But there's a good lesson there for a lot of different people, including myself, is to be a little bit more diligent around the rules and regulations and the tips and traps. So, there are people with one property, call it in the Hills District, call it in the suburbs of Brisbane or Melbourne or what have you, that could equate that very same thing could be $5,000.
Yeah,
a lot of money.
It is a lot of money. To Michael's point, it's about getting the small things right. This is not really small things that can cost you that much money. It should be high on your agenda.
Well, we often talk about
how do you do it? Like, how do you do it? Like, we've got so many checks and balances in our portfolio, and this is this is my slip up. So many checks and balances in our portfolio, but how the bloody hell did it happen? The bank contacted someone who didn't tell us that they were contacted by them, that this happened. There was no paperwork come through. There's a litany of reasons why we didn't catch it, but these things need to be caught.
100%. We often talk about manage what you can and don't worry about what you can't manage, but there's a really good example of manage what you can.
Yeah. So that's the highlight of our portfolio.
That's a great highlight.
This last week or so. And you got the numbers in front of us there, Michael. What are we sitting around? About $7 million in value and about $4 and a bit million in equity or somewhere or other. Where's it sit at the moment?
Close, but not quite the sitter. Right. So our estimated valuation of our entire portfolio is about $7.4 million.
Yep. And
we've got about $5 million wrapped up in loans.
$5 million in debt.
So it's about 2.3 odd in equity.
So that's a LVR at high 60s.
Exactly.
Yeah.
But to be fair, some of that debt is actually liquid debt as well. It hasn't been rolled over into anything else yet.
Yeah, it's so it's a LVR position of 60+%, which when you look at the current market, and we're flicking through the fin review when before we come in here, Steve, when you look at this market, which is a softening market, and you look where our exposure is in terms of property, it's Sydney, Brisbane and Melbourne. There is talk of the city market and Melbourne market falling potentially 10+% in some areas. I think where we've got our assets, I doubt we're going to see that price decline. We've seen a lot of growth in areas where our portfolio sits, so it's going to reset a little bit. But at high 60%, so I'm not too concerned about our exposure to a softening market. And I guess we're not looking to sell anything or refinance anything, so it doesn't really matter too much. It's just longer term what happens to these these suburbs where we're located. What do you reckon? How do you see it?
Look, I tend to agree. I think Sydney in particular has reset a little bit, and there might be a little bit more resetting, so to speak, or consolidation in price, because I truly think the last couple of years have seen Sydney growth go beyond where it should have been. And so I think this contraction is bringing it back to where it should be. But you're not going to capitalise the win or the loss unless you sell at the end of the day.
Yeah.
So I'd be more concerned about the management of cash flow, because that's what's going to enable us to stay in the market.
To my point I just made about this bank, interest rate increase.
Well, there's just, as we said, there's $200 a week. Combine that with the fact that the Sydney market in terms of rentals is softening, which was a given. It was always going to happen. We've got a lot of
Could we
construction.
have a chat about that? So we're talking about market cycles here. We sat in a presentation last week, maybe, from CoreLogic, which was talking about softening markets.
Yeah.
They did sort of around the grounds of all the different major capitals, and obviously Tassie, Hobart's performed quite well over the last year or so. Brisbane's plus or minus a few percent, sort of heading north. Sydney and Melbourne is going south. Perth is Perth. We speak a lot about Perth, and South Australia is sort of steady as she goes. So the insights I took from that presentation we got was that it's got to be a slow downward trend, but there's going to be a slow upwards trend as well. And they reckon that cycle is probably going to be a couple of years down, a couple of years up. Is that how you read it?
I do. I also think that there'll be markets that buck the trend, so to speak, as we're just talking about. I think Sydney is in for that softening phase, not just in terms of capital or equity growth that we talked about, but also from a cash flow point of view being rents. And
yeah, so that's what I want to chat about. So microcycles, so we've got capital values are going to soften and hopefully go up a bit, and they should go up. All reports say that, all the drivers and fundamentals for property prices increasing in the decades ahead are all pretty clear. But this cycle of how property values fluctuate and how rents fluctuate in line with that, can you just give us some insights into how that works?
Well, that's a lot of people talk about that inflection point where as the value of the property grows, so too does the rent, and then you get this inflection point where the rent exceeds all the expenditure on the property. But it's not this linear trajectory that it has. In fact, what we often see, if not all the time, is as prices increase in value, the rents tend to soften a little bit because more people come into the market. And I think that's what we're seeing in Sydney now. Given that, I think some of the, and there are different areas within areas, of course, but if you look at the Hills District, which has been a major, major boom over the last 5 or so years, the data shows that there's around a 7% vacancy rate there. Now that's big.
And there are many houses out the hills, aren't they?
No, there's a scattering of a lot of new units, in which I think was having.
Are you talking around like Borkham Hills, Castle Hill units in that sort of belt there? By the
correct.
M7,
all the way out to say, following the new light rail that's under construction.
Out through Rouse Hill way.
Yeah, correct. And whilst immigration and population growth within Australia and Sydney in particular is very, very healthy, so too is the amount of construction that we've had over the last 4 or so years. And you can build a lot quicker than the population grows. Even though there's a lot of people moving out to that area, we're starting to see that in that area in particular, and other areas throughout Sydney, that the rents are coming off, which is what we have modelled and we allow for, but we're also seeing the price decline as well.
In terms of rents, yeah.
And
property prices.
the value and the cash flow, the rent.
So you're saying is a 7% vacancy rate out that way now?
According to the data that was released yesterday or this
pretty
morning.
high.
It is. Now, I'd take that with a grain of salt, but for that sort of headline figure, though, there's a little bit of truth behind it. And this is where investors really need to be on the ball and involved in their portfolio, especially if their leases are due to expire, to reassess the market and perhaps give a little to have the consistency of cash flow there, because the numbers, if you try and keep that same rent and go vacant for 4 weeks, well, you've just eroded any sort of cash flow.
So I think about the area that we're talking about right now, and obviously being a bit Sydney-centric, we'll get into some of the other states, but there's a huge rail infrastructure going out through northwest Sydney, and it pretty much follows Windsor Road, I think is the street, the road? Yeah, Windsor Road. Yeah. I remember that road 30 years ago when it was just like a country lane. Right now it's like 3 lanes each way, and there's a huge amount of development right along that, all the way through past the Mean Fiddler pub, which I remember quite fondly from my youth. huge infrastructure development. So obviously all the developers are building up around the rail line, the rail junction and the railway stations. And they're going to keep building and building and building out there. So, there's an argument to say it's good what's happening, as in they're putting the infrastructure in and housing in to utilise the infrastructure now. But a product of this cycle is that there's a lot of properties which are going to be vacant and maybe for quite some time, until it firms up there,
Yeah, but this happens every cycle, and it's not new news, so to speak. And it's not just the Hills District; it's through the Southwest Corridor, even onto some of the Northern Beaches areas. And I actually read another interesting article the other day, which is something we've been talking about for 20 years. Is that in terms of asset value decline, the big end of town is really suffering.
Yeah,
and that's no secret either, considering that finance has tightened so much that people just can't get into that market without a larger deposit and so on. So this is history repeating itself, and I don't think that given the state of the finance environment at the moment and the economy and the health, I don't see this being an extremely prolonged period in time where vacancy rates are going to shoot up to 10% or what have you, because some of that construction numbers have started to slow now. I'd be more, as an investor, if I had some off-the-plan apartments throughout Sydney, Melbourne, Brisbane...
Be a bit worried?
I'd be a little concerned, and I'd start to really look as to how I can mitigate the end result.
So this is portfolio update, so I want to bring some connectivity in with our portfolio and this conversation we're just having right now. So this is just market norms, market cycles, things ebb and flow, move up and down, but it's about how you are exposed to those fluctuations. So I think about our portfolio, Michael. What's some of the suburbs that we're in around the western suburbs of Sydney?
We've got Mount Druitt, St Mary's. We've got Cambridge Park.
Okay.
Yeah.
Yeah, above Penrith.
Yeah. We've also got more sort of southwest, sort of Ambervale sort of way as well.
So we have some exposure to the western suburbs of Sydney, Steve. But how exposed are we? So the assets that we've acquired are in affordable belts. When I look at how markets fluctuate, a lot of it is around the buying behaviour of people. So whether there's positive or negative price pressure on a particular property. Now, when you look at the ability to secure financing right now, a lot of it is dictated by policy. It's not by the RBA or whatever. Policy is dictating investors' ability to secure funding. So once upon a time, if you're a property investor and you wanted to start securing properties around the $700,000 or $800,000 mark, because that was part of your strategy, closer to the inner cities, etc., a lot of those people who would have traditionally gone down that route aren't purchasing those properties because they can't get the funding to do so. So they still want to invest in property. They're probably coming down a bracket and looking at that sort of $400,000 or $500,000 mark. In the suburbs of Sydney where we have exposure, that's pretty much the price point that we're at. So we're not investing in off-the-plan apartments on new railway lines out in the northwest suburbs of Sydney or closer into town. We're in that affordable belt. So our exposure to the market and this slowdown, is it going to be as significant compared to other price points in this market? So do you think we're going to be safer in terms of price drops in your Mount Druitt, your St Mary's, your Ambervales, your Penriths, or wherever else we are? Are they better assets to be holding in these market cycles, is the question?
Look, I think so. That's why we invest in them. That's what our strategy is.
Yeah.
We're all long-term investors, and we know that there's going to be the ebbs and flows of market cycles. For me, what this does in these more affordable corridors is gives me security in terms of my cash flow. If I'm not rented on a $500,000 asset, let's just call whatever it may be, out in Ambervale, getting $400 a week, it's not going to hurt me as much as if I've got a northwestern corridor property valued at $800,000, getting me sort of $600 or $500 a week.
Yeah.
So it's about the modelling and the management of cash flow over multiple assets as a rather being all in on one big. Now, I'm not saying that strategy, going to the big end of town, so to speak, is the wrong strategy. This just gives us security in terms of cash flow, because at the end of the day, while we have the ebbs and flows of cash flow and property values, this gives us, again, security in the cash flow. And no one's going to take your property because of lack of equity.
Yeah.
They're going to take them because you can't meet the
afford
commitment on the debt being the cash flow. Yeah.
So we talked about Sydney there in our portfolio. Market dynamics fluctuates state by state, city by city. We're quite heavy in Queensland, in Brizzy. Mm-hmm. We're sort of southwest Brisbane. We're also up north, so we've got a bit up in Petrie, Lawton. Is that block of apartments? Kalanga, mm-hmm. Sort of that neck of the woods. We're down in sort of Logan, Spring. I Springfield. Springfield?
Yep.
Yeah. I was going to say Springwood, but Springfield, Loganshire, Kingston, places like that. So we haven't really seen these properties shift yet. They're long-term plays, and a lot of people have invested in Brisbane on the basis that we should start seeing some growth up there. We're not going to see the price declines in Brizzy, I feel, as what we will see across some of the other eastern seaboard states, Sydney and Melbourne. How are those things going to perform in our portfolio moving forward? Are they going to be strong in terms of yields, do you think? When are we going to start seeing some capital growth?
Well, we've had some capital growth, but I think the mistake a lot of people have is they compare, especially Sydney-centric investors that have gone interstate and more so Brisbane or Adelaide or what have you.
Yeah.
A lot of people have expected to see the same sort of growth, and that's a really dangerous thought process or pattern, because what Sydney and Melbourne have experienced is above and beyond. Brisbane typically and always lags. It usually goes Sydney, Melbourne, and then Brisbane starts to percolate. But the thing that Brisbane has, and not all parts, but Brisbane has some really strong interstate migration numbers. It has some strong overseas migration numbers. And the big ingredient that Brisbane has been missing probably for the last 10 years is jobs growth. And we're starting to see some positive numbers out of there as well. And then we've got the consumer sentiment level, if you will. So I think Brisbane is as steady as she goes. It's not going to break records. And to be fair, we don't want records being broken as an investor, because it doesn't give us any stability in our modelling going forward. What goes up quick must contract. Yield is around Brisbane. Brisbane's got good yields when you compare it to the average, so to speak. So while the cash flow is there, it gives us longevity in the market, and that's the important thing.
I agree with you on all those points. There's also some pretty good infrastructure underway in Brizzy as well.
Some very good infrastructure,
which is very positive. Longer term, they'll be good assets in our portfolio. And, I sort of sit here thinking now, and I look back to when we were buying in the western suburbs of Sydney, 2011, 12, I think it was. We could have bought a lot more back then. We didn't, for whatever reason. And we've documented that.
It was usually around finance.
Yeah. We're just not being ready to actually get stuff.
Correct,
but I sit back now and just go, probably could have got twice the amount of properties we could have at that point in time in Sydney, and I wish we did it. If I go back then, I'd buy up like a madman, right? It's always nice to look in hindsight. In 10 years' time, are we going to be looking back at Brisbane going, shit, we should have bought a lot more when we could have in Brizzy? Do you reckon we're going to have the same mindset?
Look, I don't think we're going to have the same rate of growth that we had in Sydney.
Yeah.
And that's a really strong point I want to make. But as with all fundamentally correct areas, and usually we're talking metro areas, I think you can look in sort of 10, 15, 20, 30 years' time and always look back and say, geez, I wish I had bought more. If I go back to when I first started investing in sort of 2000 and having seen, a dozen different property cycles between now and then, I can look back and say, geez, I wish I had bought more over there and over there and over there, and there's probably a few areas I wish I hadn't have bought in.
It's just the way it is.
Well, especially as you learn. It's time in the market, and we all know that expression, timing and time in. But it's, once again, and I keep saying this, it's the cash flow that enables us to stay in the market. And to your point, if you're saying, well, I wish I had bought 3 times as many in Sydney when you first started, if you fast forward that to now, if you had of, there'd be a massive cash flow difference to what your portfolio has today.
Oh, absolutely.
And so, unfortunately, you can't have it both ways. As you get the strong growth, the rents don't keep up.
Yeah.
And remember, we're also in a very low finance environment.
We are, and I think people need to remember, people are complaining about interest rates. It's cheap. Money's cheap at the moment,
It's very cheap.
Even though banks are moving out of cycle and jacking up rates for investors and using all these policy levers to change the way in which they make financing available to investors. But, I'm pretty excited about Sydney moving forward. We're going to see this slow price growth decline over a period of time.
Soft landing, yeah.
Soft landing. It's really working out when to start buying in the Sydney market. And, we'll keep our powder dry with our portfolio, I think. We don't need any more assets up in Brizzy at the moment.
No, you've got enough
we're
up
heavy
there.
up there.
Yeah.
Yeah. Wait patiently for a year or so, I think, and look to strike in Sydney at a point in time. What do you think of that strategy?
I think it's a good strategy. I mean, at the bottom of the market, no one will ever pick.
Yeah.
It's more luck than good management, but there's certainly some indicators there, as we talked about earlier on, to say that Sydney market has softened and will continue to do so. And I think there will be a time to jump back into the Sydney market where it represents good value, and that'll probably be when the rents start to recover and the vacancy rate drops.
Yeah.
Just like it was last cycle, where it made absolute fundamental sense in terms of the debt coverage via the cash flow where it was cheaper to own it than it was to rent it.
Absolutely.
And that's when we'll jump in. Now, that's not to say that there won't be any opportunity between now and then. There's always an opportunity if you can find the pressure points or the distressed areas, especially in today's market. But between now and then, I'd like to see some more diversification into perhaps a few of the other states as a long-term play for your portfolio.
We'll start looking at them as well. Perth, I know you've been looking at Perth, and I think if you're buying the right sort of assets in Perth right now, you probably do pretty well out of it. But I'm in no rush at the moment. I'm just happy just to consolidate for a little while in this portfolio.
I think that's an important point.
I've got other things sort of filling up my mental space as well, that I'm pursuing. So, that's the best thing about property is that if you buy well and administer it well, you can sometimes just forget about it for a little while as long as you're keeping, the meat and potato stuff done, and that is paying your $300 fees for your packages with the Commonwealth Bank. Michael, what's our priorities at the moment with our portfolio? And I said beforehand at the introduction that Michael works quite closely with me on administering this portfolio. He's pretty much central to it. He knows more about it than myself, and he's my eyes and ears, and keeps this thing running as effectively as possible. So I do appreciate it, Michael. But what's our priority for the next month or so with this portfolio from, keeping a thing running and smooth? Is it really just finalising these new fixed rates with some of the lenders that we're working on? Where are we at with that? Is that done?
That's right. So I'm working through at the moment with Ross and his team. Yep. So essentially, we've got a couple of forms. There's always more forms to be filled out.
There's no shortage of forms in property investment.
We love a good form. We're working through those forms at the moment. Essentially, we're working through the CBA ones, just making sure it all matches up, and we're just making sure the pricing that we looked at originally with our mortgage broker sounds like that's what we're going to get. Yep. So once we've got all that ticked off, that'll be in place. So that's our focus this month.
Okay, cool. Well, it's pretty important because as we identify, we can shave $25,000 in interest repayments off. And we don't know what's going to happen with lending moving forward, so we can lock in some fixed rates right now. I think they're pretty reasonable as well for 4.7%.
Yeah, exactly.
Which is much better than the sort of low fives that we're paying right now. So there is a considerable saving there. And
I don't think anybody knows what rates are going to do. Not even the smartest people in the
everyone thinks they know what they're doing. Well, we just saw in a Fin review they reckon there's not going to be any official cash rate increases in the calendar year of 2019. Is what we. 2019?
Yeah, but there will be from the banks and the lenders.
Yeah.
There has to be. The cost of funding has gone up. Their profit margins are shrinking. But at the same time, I think what we'll start to see is some really attractive honeymoon rates for owner-occupiers and investors, those that are prime borrowers, so to speak, because at the end of the day, the bank makes money by lending it. Yeah. So I think in terms of your rates and the potential lock-in sum and save $20,000-$25,000 a year, it's $500 a week. It's a lot of money.
That's a huge amount of money.
And you combine that perhaps with the other, what was it, 10,000?
Yeah, stuff that we're saving by keeping our administration pretty good. Yeah,
yeah, and
it adds up.
Well, I think, and the point here is that being involved in the portfolio is just so crucial. And you should put, not you, I'm just generally speaking, but the time should be put aside for every investor out there to put the time delivered into it, and you will save money. You will protect that cash flow because it is a big asset.
I completely agree. And the point I make on mortgages is that speak to, if you don't have a mortgage broker, go and get one, because if you're looking to invest in property in this period ahead, a lot of lenders, obviously there's a lot of policy dictating the way in which lenders are channeling money through to investors right now, but depending on how lenders are performing against the requirements set by APRA, often they'll do a bit of a run and say, okay, we've got a bit of fat here, we can pump in a whole bunch of mortgage business for a period of time. So what will happen is that mortgage brokers will be notified by these lenders that they have some preferential pricing or some sort of specific policy discounting around a particular product. So if you're not connected in with that story going on within broker land, you're not going to know about these things coming on. So a good broker should be presenting new solutions to you for preferential pricing with the lenders that they work within, and be connected with that, because
100%,
and it might not be with one of the major banks, it might be with a second tier bank or a non-bank, and keep an open mind to those type of products, because we've got some good second tier lenders, I think we call them, in our portfolio, and second tier doesn't sound very, very nice, but essentially it's banks who aren't the major 4 banks or 5 banks, including Macquarie. So I'm talking like your Suncorps or your INGs.
Non-deposit taking.
Yeah, and it's really, really good lenders out there. So keep open to that.
I think the whole idea around broking or mortgage brokers is so underrated. I think it's such an important part of your subject matter experts. They're across hundreds of different lenders, and we all know that. But as a consumer, we can't be expected to know every policy, every product.
You're just not going to know about it.
We don't do it 100,000 times a day.
Yeah.
And so a really good broker pays massive dividends, I believe. And that's just one part of your team that you should have.
Well, to your point, it's a central party team because, you're a property strategist, which involves everything that encapsulates, buying, investing, managing property, including being a buyer's agent. But you always say that property investment is a game of finance,
For sure.
And you got to get your finance right. So that's really good counsel. Good. You happy with that, Michael?
Fantastic.
Yes.
As always.
Have you any particular frustrations about this property portfolio and dealing with me? Is everything okay?
No, I think we're going just fine at the moment.
Yeah.
The portfolio does really run itself. So.
Yeah, it's good. And the reason why is that you've put some great systems in place so we can keep across all these things, and if you don't have those systems or processes in place, go and find some, make them yourself. Whatever works for you is pretty important.
It's not a set and forget vehicle, is it? And this whole premise around a passive portfolio, that's just rubbish at the end of the day.
Well, I said that, we don't need to do anything with our portfolio even if we don't do anything for a year or so. I'm talking about being proactive on the buying side. We still need to maintain and manage it and be right across it because, what we're trying to do is we've bought assets we feel are going to go up in value, and if we can minimise the cash to hold them as much as possible, that's when we get the maximum impact in our portfolio for this period of time.
Just a question for Michael. So if we get these rates sorted, and that could be somewhere between $20,000 and $25,000 a year saving, what would be the pre-tax holding costs on the portfolio?
Pre-tax holding costs, it'd probably drop us down to about 30, I think.
Yeah, I think we haven't finished obviously our financials yet for the most recent financial year. We're working through that at the moment, but I think it would put us about $30,000 pre-tax.
Yeah, about $30,000. So it's a huge saving. Like we essentially halve our holding costs, right?
Yeah,
and for a lot of people, $30,000 sounds like a lot of money, but I've got to preface that by saying there's 20-something properties in this portfolio. I can't remember.
Yeah, we've got 18 doors.
18 doors. So your holding cost per property isn't that considerable. So it's like $1,500 a month per property, right?
Yeah.
And that's also taking into account that we take into account the different entity costs and trust setups,
trust structures. We get, if we save $25,000 in interest repayments and we removed, and these are all what ifs, right? And we removed the fact that we invest in a trust and didn't have to pay any land tax. It'd be neutral pretty much. That's a huge cost.
So there's always a trade-off.
Cost to operate. It's a trade-off. So anyway, good. I think we've gone for quite long there. Sam, our producer, he's okay. He's thumbs up. Right. Nice one. Thanks, Michael.
Thank you.
Keep it up. Good. Steve, thank you.
Thank you.
Appreciate it. Thanks for joining us today. Remember to check out smartpropertyinvestment.com.au. Click the Our Portfolio tab and you'll see everything we have done around our portfolio, including all these podcasts, plus a whole bunch of stories that we're doing as well. So if you've got any questions around our portfolio, we're going to do a Q&A session pretty soon. Email the team editor at smartpropertyinvestment.com.au. If you want to keep connected with what we're doing, social media, Smart Property HQ, track us down, like us, follow us, and you'll keep abreast of everything. If you prefer to get your info via email, the old-fashioned way, we have a morning newsletter, smartpropertyinvestment.com.au/subscribe. Get involved and we'll make sure that you're the first to know what's going on in property. And please keep those reviews coming on iTunes. We do appreciate it. Lots of shout outs to our most recent people giving us reviews. And I like the fact that you're giving us 5-star and you think I'm doing a pretty good job. So I'm okay for a bit of criticism. If you want anything in this show that you're not getting right now, or there's any way in which I can improve the way I'm delivering this information, or perhaps coordinating some of the guests coming on, email the team. It'll come through to me direct, editor at smartpropertyinvestment.com.au, and I will try to do what I can. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.